Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 25th of March. I'm Daniel Lam, your host for the podcast. Gold had been coming off from the mid-5,000 level, its all-time high, which was hit in January, and testing the 200-day moving average just above the 4,000 level earlier this week. Now, we've seen similar behavior in the past during periods of heightened market stress as investors raise cash to pay for margin calls or simply be booking profits where they can. This is also due to the recently strong US dollar from hawkish repricing of Fed rate expectations. Thus, money managers' gold positioning has turned bearish lately. And historically, this kind of liquidity-induced sell-off can last for 4 to 6 weeks. Well, to us, this is an opportunity to be adding to gold. Now, in our base case scenario of a short-lived Middle East conflict, we're expecting the US dollar to weaken over a 6 to 12 months horizon as the Fed cuts rates to revive a fragile job market, as it looks through a near-term rise in inflation and cut rates by 50 basis points by the end of this year. Now, a weaker US dollar should support gold prices. There has been rising demand for gold as an alternative investment. The past year saw a rise in investor demand towards gold bars, coins, gold-backed ETFs, and digital gold. Amongst institutional investors, gold remains underowned, with significant scope for upside. Now, if the conflict in the Middle East subsides, we expect structural factors to be back in the driving seat, leading gold prices higher. First of all, there is geopolitical uncertainties. Emerging markets have been consistently increasing gold reserves in the past 4 years, especially after the US and EU decided to freeze Russian central bank assets following the Ukrainian war in 2022. As of February, the top 3 EM central bank gold holders, China, India, and Russia, had around 20%, 17%, and 45% of their reserves in gold. The Middle Eastern conflict is likely to be bolstering this trend. There have been concerns about expansionary fiscal policies. Now, fiscal policies continue to be relaxed worldwide, led by the US, Japan, and with Germany joining in this year. This has raised concerns about long-term debt sustainability, and the Middle East conflict is further increasing US debt, with the Trump administration proposing to seek Congress approval for a $200 billion boost to defense spending. Lastly, there are concerns about the Fed's independence, with Trump seen as intervening with the Fed affairs and his nomination of Walsh to replace Powell when his term ends in May this year. This can lead to dovish Fed policies, therefore a weaker dollar, and therefore tailwind for gold. We have a 7% allocation to gold in our balanced diversified allocation and expect gold to rebound towards $5,375 per ounce in the next 3 months once the de-risking phase passes. Over a 12-month period, we expect gold to gain further towards the 5,750 level. That's all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.